The market fell again. So that's like 3 times in a row now. We haven't had this long of a. This is like the golden state. S&P 500 has been the Golden State Warriors of the financial markets, and they're on a little bit of a losing streak, and we don't really know what to do about this. So today I'm going to talk about what to do about this, including a major theme that's been going on that a lot of articles have been written about in terms of, how it could be a bad thing for the market. In reality, maybe not that bad of a thing after all. So I'm going to break down where we expect the market to go in the near term, where we expect it to go in the intermediate term, based on what the patterns are showing us right now, including a trade idea on an asset class that is showing some weakness and how we can take advantage. Let's go ahead and get started. Today is Tuesday, December the 5th, 2017. My name is David Settle. This is my market outlook for the day. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button that's right down there below the video. Hit the thumbs up that's right next to it. That lets me know that you found today's video useful. It's a way to like the video. One-click feedback. Can't get any easier than that. Scroll down further and comment on anything that stood out to you from today's video. Any light bulb moments, anything new that you learned. I'd love to hear what you're getting out of these videos. In the video description, there's multiple links for you, including one to join the daily email Market Outlook newsletter. So subscribe, click on that link and subscribe so you can get that time-stamped summary of the videos every day to your inbox, as well as a list of the overbought and oversold clusters in the S&P 500 every day. So click that link and subscribe. Follow me on Twitter for more content in addition to these videos throughout the day, throughout the week. You'll see my handle on the screen at DavidSettle42. Pinned to the top of my timeline is tonight's Market Outlook tweet. Please like and retweet that tweet from there. And of course, join the Market Outlook community. Again, we're over 700 strong, so come join us. It's our Facebook group. The link is up here at the top of the screen. There's also a link in the description that you can click on that will take you there. Just click on Join the Group. All right, let's go ahead and take a look at the S&P 500 with the Market Forecast Indicator. So, 3 days in a row to the downside, which we haven't seen 3 days in a row since right here, this August 8th through the 10th. Period. It's the last time we've had 3 consecutive down days. So, granted, it's, this first day wasn't so much of a down day, and we started up so strong, but long lower shadow, followed by an engulfing pattern, and then now closing below, the low of the high day, because yesterday really was the high day of this rally, because it's the day that we had the highest high. We hit the highest peak yesterday, and that's where the near-term line retracements end. This near-term rally, which finally got below 50. This is where the intermediate line move is, and you can see, we're pulling back now. On the near-term level, we're pulling back down to that 38% Fibonacci level. The momentum line, so not only did the near-term line pull back below 50, momentum line pulled back into the reversal zone too. So you would say on this chart that this is a picture-perfect intermediate confirmation signal, because with an asterisk. I'm going to explain in a second. But you would look at it on a higher level, on just a broad level, and say, okay, great, buy the dip opportunity here. Strong bullish posture still, and an oversold momentum line. Now you add in the fact that the near-term line's below 52, great, because now, that's obviously a higher near-term low than the last one that we had, which is over here. In fact, I should probably duplicate that now. That's the current near-term low that we're forming. This is the last near-term high, which was much higher than the previous near-term high. We've been getting progressively higher near-term highs every near-term run. So now we're pulling back. We've pulled back to 38% Fibonacci retracement. Perfect. Buy the dip opportunity, except for one thing. And that is the momentum line has dropped down to an extreme low point. So it dropped below the 5th percentile. When it drops down there, say obviously it doesn't do this every time, but when it drops down there, that is a sign that we could be changing the trend here pretty soon. From what is currently a strong bullish posture, changing it to a weak bearish posture. Because remember, strong bullish trends do not turn into strong bearish trends. Strong bullish trends turn into weak bearish postures. Right, and then of course that weak bearish posture gains strength as it goes, but it doesn't turn into a strong bearish posture right off the bat. Right, it starts off weak. And that weak bearish posture can turn, just like this one did here, right back to a strong bullish posture, just like that. So the fact that the momentum line is down to an extreme low suggests, especially when you consider the maturity of the intermediate posture we've been talking about for the last so many days, and the fact that market sentiment's so high. Now, this doesn't mean we have to tank. So I hope you're getting that message loud and clear, that the market doesn't have to go to the moon and it doesn't have to tank. Those are not, it's not binary. There's a lot of in between. There's a lot of grinding that can go on. There's a lot of sideways action. There's small ups, there's small downs. And when you've been so strongly to the upside, we usually don't then transition so strongly to the downside. Usually we kind of mess around here for a while while moving averages and the like catch up. Now, the opposite is true. Like we will go from a strong downside to a strong upside, just like that, because at the strong downside, volatility is a lot higher. So we can get bigger moves. We can get V bottoms. So the shape of a V on the bottom, we typically don't get, upside down V tops. That's not the nature of, because typically volatility is a lot lower at these levels than it is, say, down at a lower, even when the intermediate line is forming a low point like it is here. So, and of course, you've got the divergences like crazy set up here with the MACD, and you see on the other indicators too. Crazy divergence. So that the divergence here on the intermediate line actually puts this low here into play right about where the 38% Fibonacci retracement is for a target. So you're looking at a move potentially down to 25.75 based off that intermediate divergence, plus other indicators that are showing similar patterns. So that's what's going on the S&P 500 right now. So again, bullish posture, pretty decent buy the dip opportunity as is, but an extreme low, and you can see on the Dow too, an extreme low, coming in this case off of a long lower shadow, so a hanging man candlestick pattern, followed by a candle here with a long upper shadow where we close at the low, and then now a close below the low of the high day, that dreaded kind of reversal, short-term reversal pattern. Again, this, it looks like a good buy the dip opportunity, but that extreme low point would say we're probably going to get more of a near-term pullback now. And again, so don't say, oh, David said we're bearish now, right? We haven't had much of a near-term pullback at all on any of these moves, and enough to bring at least the intermediate line below 50. Now, granted, the intermediate line could drop all the way to 0, and things could really fall off, but not tomorrow and not the day after that, right? It will, at first you expect, this strong bullish trend to turn at least into this weak bearish intermediate pullback, enough to bring the intermediate line down. Let's go back to the S&P really quick. Enough to bring the intermediate line down below 50 and to form a higher low point in this area. When you got a trending market, that's your first expectation, right? Into this 38%, 50% retracement, 25.50 or higher. That's kind of the first kind of level of expectations that we look for. If we hold that and we bounce, great. Then we continue higher off a new intermediate low point and see how much further that goes, as the new intermediate trend goes. Considering market sentiment is as high as it is, that one probably won't last as long. As, say, this one did, where we started below 70, or this one over here, where we started from below 65 and had a decent rally for a while. All right, go back to the Dow Jones Industrial Average here really quick. So you can see very similar pattern. Look at the NASDAQ Composite, which has been beaten up today. Long upper shadow. Not the best sign when you got this kind of top formation forming. And here you can see its near-term line after forming a bearish high point between 50 and 80. It is now down in the lower reversal zone, and the momentum line is not below 5, but it's getting down there. So very oversold short-term sentiment and a weak bearish posture. So the first index to show a weak bearish posture, the NASDAQ was down more than anybody today, or the Russell 2000, long upper shadow, coming a day after this long lower shadow, retesting this old high point now. You can see extreme low on the momentum line, near-term line, and you would say buy the dip, but not a buy the dip, right? Not with how extreme that is. Now, we can speculate. You can say, okay, well, it will hold the support and bounce. But again, considering the bearishness and the maturity, especially in the broad market, the S&P, the maturity of the postures that we have there, there's likely going to be a deeper pullback now than just a 3-day short-term buy the dip pullback. Now we'll take a look at the weekly chart, and there's an interesting candlestick pattern forming on the weekly chart. So it's not quite there yet, but this is what would be called a dark cloud cover candlestick pattern, where you have a relatively larger, in this case, open body, so it's not filled in, and it's white, so it means we are up higher than the previous week's close. And now we have a filled in candle, which means that we're closing on the week so far lower than where we opened. We did gap open. You can see there's your close from last week, there's the open for this week, so a gap up to the upside. And if we were to come down to this middle point by the end of the week, which we've got a few days left, 3 more trading days left, so if we were to come down to that midpoint or lower on this by the end of the week, then, and especially closing at the low of the week, then that would be what's called a dark cloud cover candlestick pattern. It would be bearish. Of course, it'd still be above, upward trending moving averages. The MACD would still be about as high as it's ever been. So it's not like we're talking about the wheels coming off here, but it definitely would suggest, again, this theme from the market forecast that we should expect more of an intermediate pullback. Again, not a deep intermediate pullback per se until support breaks, but at least more of a intermediate pullback down to those Fibonacci levels that we referenced before. When you look at the 3 green arrow charts, we still actually have 3 green arrows. So yeah, we're pulling back on the MACD and the stochastics, but you notice we're still above, as big a pullback as it has seemed the last 2 days. We are still above the 8-day exponential moving average for the S&P 500. So think about that for a second. That's pretty, that just shows how far above the 8-day moving average we were, and how hard it is to sustain that kind of momentum, that strong momentum. You can see the MACD is still above its moving average. The stochastics has dropped below its moving average, but still in the reversal zone. So buyers are still in control because of how bullish we were before, and we're just getting a slight near-term pullback right now, but definitely something to keep an eye on. As we mentioned, these kind of divergences here. Now we did pop up to higher highs on the MACD and slightly higher highs on the stochastics on their moving averages as well. So it kind of takes out those divergences there. But you can kind of see, if I take a look now at the NASDAQ, which remember has shown a bearish posture right now, it is below the 8-day moving average and the 17-day, and today just a smidgen below the 6-week moving average. So a lot deeper of a pullback. Its MACD, there's the divergence that it's had on its MACD. Its MACD is coming back down below 0. You can see we've come down to these low levels before and hit the 6-week moving average for a support level. So we'll see if that continues to hold. Again, you expect support to hold until it doesn't. And if it doesn't, then we know we're going to have more of a deeper intermediate pullback than we expect. And there's your Russell 2000, which also broke down below the 8-day moving average, but still above its 17-day, which is the next step on a pullback here, is breaking below the 8 and holding the 17-day. So again, we're at support levels. There could be a short-term, near-term bounce. Don't expect it to be one of those near-term bounces of that last 7 to 12 days, maybe 1 or 2 days, to form another bearish high point, near-term high, and then more of an intermediate pullback. So, we're not looking for new highs here anytime, at least in the next day or two. But considering how much we pull back and how bearish, all the coverage seems to be, don't be surprised if we don't bounce another day or two here by the end of the week. And then we'll see what Friday brings with those jobs reports and how that impacts those rate hike expectations. Because again, you've got this possibility and the possibility of this bill, this reconciliation going on between the tax reform bills, and how that impacts markets, because the part of the selling has been some of the elements in that tax reform bill that impacts retail investors, that impacts some of these corporations that were expected to get more of a tax break than what they may get with what's still left in different versions of that bill. So the S&P 500's intraday chart shows a lower high and a lower low. You can see the high was early in the day, not at the open. so not as bearish, but still relatively early in the day. The low of the day was right at the end, so pretty, and we closed below yesterday's low point. So a bearish candle in that respect. Closing, but again, context here in terms of how bearish we are right now. We can pull back down to this 260.50 area and still be fine from a near-term pullback. Once we break into this, then we know we're on track for that deeper intermediate run. And now, not one that's not a hugely strong one at first, right? Because you got, I mean, the Fibonacci retracement for the S&P 500, the 38% Fibonacci retracement for the intermediate run that we've had is going to be below 25.75 in that area. So look at that on SPY. We're looking 25. That's going to be down in here. So that's going to be, a move down to the 4-week low point would be that first kind of expected intermediate run. It would be a weak one, but probably would be enough to get the intermediate line back below 50, and we can look for a buying opportunity, a dip there. Not a strong dip though, because the market sentiment probably won't drop very much, but you can kind of get an idea of where we can expect it to go. First for this near-term little move that we have going on for this support in this area, but then down to the 4-week low point eventually for that kind of deeper intermediate run. So you can see, you would think that, man, that's really not that big of a deal. Now it's going to be a big deal because the market's not used to this level of volatility. We're used to just really small grinding moves and one-day pullbacks that the market buys a dip intraday. So that would be a little bit more of a dip that we've had, and so it will seem very hurtful, especially if you bought a lot of stocks with high risk and very speculative at these areas, right? Trying to chase the high returns that we've had to get into, that we've had to get to these areas, this spot. If we take a look at the range here, the range today was over 2 points. And you can see we pretty much closed just about where we opened here. There it is at the bottom, and the volume at 77 million, so down but still above average. So we'll put that move in the context. So 2.1 points is still above this ATR, still bringing this line up, and 77 million is just slightly above average here. So we kind of need these numbers. So again, if we're expecting a 1 or 2 day pullback, a bounce on a near-term bounce, if it's a kind of bounce that has kind of strong, big ranges and strong volume, it's not trusted. It's not going to be trustworthy. 1 day, okay, but it should start to really taper off to small moves, almost, really, really closely. Start bringing these lines back down. Then we'll say, okay, we're going to go. But if we get a 1 or 2 day bounce and it's a big move and there's some volume associated with it, and especially if we end up with a long upper shadow, kind of like that rally there, if we get that kind of a day, then we know it's not going to be a typical near-term run, and we're still going to make that move back down into the lower end of the 4-week range. Whether we'll break that range or not, usually we don't break the 4-week low point when the range is big. Usually we break the 4-week low point when the range is shrunk. So we can come down there and fill the range, and then kind of hold that area for support, and then and then grind around for a while until the range shrinks a little bit more. In terms of volatility, you can see the volatility didn't go up very much today. So it was down. In fact, it ended up being down 3%. But again, keep in mind that we're up off the low. So volatility is coming up potentially off of a higher low point here. And when you look at it on an absolute basis, you can see we're still, we're not at extreme lows. We're in that kind of, sweet spot for a bullish trend. So again, when we're looking for that support, for a near-term bounce, we got another element of support here for a near-term bounce, short near-term bounce. But that kind of tells us too, we're not tanking right now. Volatility doesn't tell us that we should expect, or the market's expecting things to really tank right now. But if it starts to move up and down slowly, then that's going to set up for that. That one big spike that comes out of nowhere. Eventually, it's going to come. We've seen it before. When that big spike comes out of nowhere, it doesn't come from down here. It comes after we've started to trade a little bit higher, and showing some higher highs and higher lows a little bit, and started to trade up in here, and staying up in here a little bit more. See, before we get up here, we come right back down. If we don't come right back down to these lower levels, then we know, okay, the pressure's building. That potential energy is building there for more of a VIX spike. That one expiration cycle, huge move in the VIX that just comes out of nowhere. All right, now let's talk about what's driving the price action today. And you can see there's a few things that I tweeted out throughout the day. One of the biggest things that I tweeted out, and again, to make sure you're getting all these tweets that I put out throughout the day, make sure you're liking and retweeting those tweets that you do see, especially like the market outlook that I got pinned at the top. That's probably the easiest one. The more you do that, the more you like and retweet, the more Twitter will keep pushing you my stuff, because you're engaging with it, and number one. And number two, for my benefit, the more they'll keep pushing my stuff out to everybody who follows me, and because it's engaging stuff. They see there's a lot of likes and retweets. So, but you can see here, you'll see a lot of things today talking about the yield spread dropping to below 60 basis points. The last time it's been this low, it's been 60 years. If I were to take a look here, 60 years, 20 years, 10 years, sorry. It's been all the way back here. This is where you see a lot of chatter. But again, back in the December 2007, back in this area, November 2007, the yield spread was rising. See, we're below 60 basis points here. So really the last time that we were falling below 60 basis points like we're doing now, and you see in early 2005, it was tanking. The yield spread was tanking as much as it was now. And the Fed was raising interest rates all the way to the summer of 06. They were raising rates every meeting, 25 basis points from 04 to 06. So the Fed was raising rates and it was tanking, similar to what we see right now. So nothing different. So don't get caught up in a lot of the stuff, the articles and things that points you to the yield spread. And I've, again, what does a flattening yield curve mean? It's not what you think it means, because the last time we were tanking with the Fed raising rates this much, the market continued to be higher, and then in that last case, from March of 05, the last time it dropped us, until the market eventually peaked in October of 07. So it's 31 months, almost 3 full years, 11.5% annualized return. So 32% total, 11.5% annualized return over that whole time frame. So it's not like this is a bad thing to see that. And you'll see that because they'll say, oh, well, the last time it was, was 10 years ago, and the market was tanking 10 years ago at the end of 2007 and into 2000, in 2008, what came after that? No, we're not rising to these levels like we were then. We're falling to these levels, and that's 2005. And so that's kind of what I wanted to point out there with this tweet was, the comparisons to 05, not to 07, that's a big difference in terms of expectations. So, I talk about this potential for an intermediate pullback. That doesn't mean that we're going to have this big bear market, right? The market can still continue to be bullish according to past precedent when we've seen that happen before. We take a look at what's going on here. Let's change this to a darker so those colors stand out a little bit more. To see what's going on and what's rallying. You can see U.S. stocks still have the best performance over the last 2 weeks. They didn't have a very good performance today. You can see treasuries, the yields, those long-term yields are falling. See, the short-term yields keep rising because the Fed's going to raise rates, and you see the expectations are the Fed will keep raising rates. You can see it over here. I mean, look at this. This is for only one rate hike, and that's starting to drop. And why is it starting to drop? And because you have, or excuse me, this is for, let's see here. Yes, okay. So the purple line is for no rate hikes after December. So the purple line is the December rate hike, and that's the only one. So you can see it's falling now below 20% still. The red line is that we'll get one rate hike by June in 2018. That's falling. And why is it falling? Because the odds of 2 rate hikes in 2018 by June. So March and June, you can see it's starting to rise higher. Now the gap between it and no rate hikes is really taken off. And you can see this line down here is 3 rate hikes in 2018 by June. And that's still very, very low, but it's rising and almost to the point where it's about to pass and we'll eventually the fact that we won't get any. So I mean, just in September, just a couple of months ago, we had higher odds that we weren't going to get. In fact, at the beginning of September, we had odds that we wouldn't even get a rate hike in December. And then we had the pretty decent odds that we'd get one in December. And then one more in June, starting to rise. But these were still down here. But now you can see how for 2 rate hikes, how it's really starting to take off. So and that impacts a yield curve. It will keep putting pressure as long as the Fed keeps raising the short end, which would impact the 5-year, and the economic conditions don't support a high yield on the long end. And we saw that, with what's going on here today. The TLT is at 20 to 30 year. The bonds rallied, yields dropped. So that's why you have that yield curve flattening like it is, and that's going to impact some sectors. The last time we had, that we had that condition from 05 to 07. I'll show you here in a second when we get to the sector rotation. Let's finish this segment up here. Again, U.S. stocks were outperforming. They pulled back today, and they underperformed international stocks. And remember, the international stocks have had a pretty decent relative run this whole year, and 1 year doesn't come close to overcoming that years of underperformance the international stocks have had to U.S. stocks, because the U.S. has been very aggressive in its monetary policies to help keep the stock market afloat. And on the down in here, gold, with the dollar rising, with those rate hikes expectations rising, gold still very bearish and pushing down pretty sharp. So now from a sector standpoint, before we look at that previous picture, you can see technology has been weak. It continues to be weak. Real estate continues to be weak. Utilities, despite the rise in bond prices, utilities continue to be weak. Usually utilities and real estate go down when yields go up because of the competition there. Well, that wasn't the case today, and so that's why today's move, utilities leading the way down lower, industrials giving back some of its gains. You can see technology bouncing back up, and a little bit of a, kind of a short-term bounce after being sold for so long. But you can see, again, if I put it back in context of the 2 weeks, that bounce that hasn't done enough, we're still at the low of the day by the end of the day, and we're still at the low of this 2-week period. So pretty low for the week. And if I were to go out to the 20-day period here and look at their 20-week range, consumer staples still trading relatively higher, doing pretty darn well. From this 0% level and trending higher. Consumer stocks in general have been doing very well over the 2-week period, but you can see technology is at the bottom of its 4-week range, not just its 2-week range. Energy is off of its 4-week lows and is coming down from its 4-week highs here as of yesterday. And you can see utilities are pushing down to new 4-week low points. So these are some pretty bearish moves, and we've seen bull market pullbacks where there's not very much of a risk off type of a pattern, more just kind of profit taking. We've talked about that before, and the market's continued higher. That's not the case for this one, and that's why, again, while we may get a 1 or 2 day bounce, the odds of more of an intermediate pullback that we've had for a few months are starting to increase, getting higher and higher. So here's the sector rotation. I know it's pretty squiggly, but there's 30 some odd months here. But I wanted to look at the daily chart. The white line is the S&P 500, so up about 30%. Since the yield curve dropped to the current level, like it's dropping now, the Fed continued to raise rates all the way to about right here, and you can see financials like that. They still continue to outpace the market. Real estate, of course, had its run during that part of the decade. That's why it did so well. And energy had a run during the middle part of the decade, and that's why energy stocks were doing so well. Other than that, the only other things that outpaced the broad market were utilities and financials, with everything else, technology, discretionary, everything else lagging behind. But by the end of this period, so this 2-month run, by the time the market itself peaked. So the yield curve the yield spread had inverted, and it had bounced back up to almost these levels within about a month after this. It had bounced back up to almost these levels. So so in the course of a couple of years, from coming down and then back up to current levels, technology, materials, you can see real estate bounced up here in 2007 to make that last run. Utilities as well, technology as well. You can see financials dropped once that yield curve inverted. Financials started to really lag behind. Consumer staples and healthcare were lagging behind. Safe haven areas and the consumer discretionary lagged the whole way here. So energy was really the biggest mover and why we kept going up to a higher high. The question now is, what's going to be our energy? Because nothing else, I mean, that was up to its own highs, like the market, its own all-time highs. Nothing else was. Everything else, well, technology was up to its all-time highs. It looks like in industrials too, but utilities was off. Real estate was way off of its highs. Discretionary was off of its highs. Financials was off of its highs by the time we hit that peak in the broad market. So we had been rotating into what we still had one kind of hot sector left. Unless we come out with a sector that's specific in the S&P 500 for Bitcoin, the question now would be, what's going to be that one hot sector that rides us through like energy did and real estate did? That falling of the yield curve and subsequent inverted yield curve, and then bounce back up, because those are the two areas that kept the market going. Mostly, including financials. Those are the three areas that really kind of kept the market going up to strong 20% return by the beginning of 07 and 30% return by the time the market peaked. All right, so for our trade idea of the day, I want to take a quick look here at Newmont, and you can see gold really starting to drop here. Newmont being in that industry and the dealing with gold. You can see gold dropping below these lows. In fact, it was further down when I was looking at this earlier, and was outside of the Bollinger Band, which is bearish. But the gold's not really benefiting from. Oops, forget that we have to use this symbol. They're benefiting from the idea that this dollar started to bounce up a little bit. And obviously the rate hike expectations and again this kind of pro-U.S. Tax reform type of a situation to bring a lot of this money back and make U.S. business competitive again. The implications that can have on the dollar obviously would put pressure on gold. Now, gold would rally if there was any kind of geopolitical news coming out, like say Korea, and it could rally some. If the markets were to have a more extended pullback. But if the dollar's rallying and these rate hikes are rising, traditionally put some pressure on gold. And you can see a stock like Newmont, it's got 3 red arrows today. We're close. The momentum had one, MACD had one, so it's hovering right there at 0. You can see that it's coming down from a lower high. The last low point was 37. We bounced off of that. We did not bounce up to lower high point. So we got our first set of 3 red arrows really right there. The first one on this downward trend. Then we went to a lower low point, got a little bit of a head and shoulders pattern developing. You can see if I were to say, okay, well, if that head and shoulders, if this is the kind of the move, then I would duplicate that here. Whoops. And move this to the downside. You can kind of get an idea of where the target would be. Based on the head and shoulders pattern, and that makes sense because there's a bunch of support in this area down over here at the bottom of that head and shoulders level, so right in that area at 32. So you say, okay, well, we're kind of on a bearish trend and we're rolling down from a high. We're closing below the low of the high day, and we got 3 red arrows, a decent volume, which you typically get to the downside. Okay, well, can we make a bearish trade? Well, maybe we might be able to buy a put here, going out, in this case, 73 days to avoid significant time decay. Looking at that at-the-money put and going for a 2-to-1 reward to risk ratio on it, knowing that, I probably won't take the full 71-cent loss. Where if it were to bounce back up here above 37 and a half, we'll just take our losses on that. And I've got this line here because that line tells me if the stock, barring any change in volatility, so no change in volatility, if the stock drops to 33.23 by January the 25th, then the theoretical price of that option, including the time decay, would get me. So if there was no price change and no volatility change, time decay alone would get me to my stop order. So if I just waited out a nothing move for that long, that's when I'll finally hit my stop. But if the market dropped to that target, that price level, which is what's right here, around 33.23 by January the 25th, then right there is my pace that I need the stock to get to for my option to hit its target. Now, if we come down, and you can see it's got this, once you break through support, it's got a precedent for really breaking through pretty sharply. If it were to drop down here and get down to this level faster, which is easily within the Head and Shoulders pattern target range, then obviously I'll make a lot more money because I won't have as much time decay. See, time decay, as we move across, I'll lose money to time decay. So if we hit the target faster, great. If we get to this halfway point and we're still up in here, then we'll just take whatever loss or whatever small gain we have and call it good. And because it's not moving fast enough, we'll move on to another trade at that point. So to summarize, the market's had a pretty decent pullback, a little bit of a losing streak, the biggest losing streak it's had since August. So it's been a few months. We're in a mature intermediate trend, a mature long-term sentiment, market sentiment as well. So we were due for something. Now, granted, are we going to start piling into a strong bearish posture? Most likely not. In fact, the expectation is we'll probably get a bounce, a day or two of a bounce potentially, and which will then eventually lead into a little bit longer of a near-term, intermediate pullback. Not one that will change the long-term trend to this bearish trend. Still the potential for higher intermediate lows to develop. Yield spreads plummeting, but that doesn't necessarily mean a bear market yet. And there's still potential for things to continue to rally from a technical perspective. But not without some kind of breather, right? Not without some kind of exhale. And it looks like the market's setting up more and more for one of those. All right, thanks again for watching tonight. I hope you keep coming back for some more here tomorrow. Remember to subscribe to the YouTube channel, like today's video, comment if anything stood out to you. Also remember to follow me on Twitter for more content. I'll post some stuff throughout the day tomorrow. Also remember to like and retweet as you see those stuff coming through, including tonight's market outlook, to make sure that Twitter keeps pushing my content to you. So as always, thanks again. And join the community. We're almost 700 strong in the Facebook group, so remember to join our market outlook community to keep tabs with each other and helping each other use this stuff. So again, thanks. Have a great evening, everyone. We'll see you all tomorrow.